Ladies and gentlemen, good morning, and thank you all for being here. It's an honor to be back in Kuwait, a country that is close to my heart, where I had the privilege of living for a couple of years and built memories that I still carry with me today. It's also an honor to share the stage with this outstanding lineup of speakers. Anwar, Tariq, Abdulaziz, thank you for joining us. Together, we'll be discussing how the region is adapting to a multipolar world. But before we dive into the discussion, let me set the scene with some broader context with which Kathy did a great job. Thank you, Kathy. I'd like to start with a line that really stopped people in their tracks in Davos 2 weeks ago. Canadian Prime Minister Mark Carney stood on that stage and said, "The world order as we know it is dead." He urged leaders to stop invoking a so-called rule-based international order as if it still functions the way it was designed after World War II, the system that gave us the NATO, the IMF, the World Bank, and the United Nations. Instead, he argued, we are now living in a far more fragmented world where the most powerful pursue their interests through economic pressure and geopolitical leverage. We see this playing out in Europe, questioning its long-standing alliances, in China, asserting its influence through BRICS and the Belt and Road Initiative, and the United States seeking dominance in its Latin American backyard. So against this backdrop, the question for the Gulf is not whether the world has become multipolar, it clearly has, but how the GCC adapts, how it balances economic diversification with energy leadership, deploys sovereign wealth strategically, and positions itself as a vital bridge between the East and the West in a rapidly changing global order. So let us start these discussions with you, Tariq. Do you share the view that the old world order is dead? And what does it mean for trade routes, for capital flows, and risk pricing?
Thank you, Laura. Bismillah wa salatu wa salam ala Rasulullah. Thank you for the kind invitation to be here, to be a part of this important discussion. I think I'm not the only one who listened to Mark Carney. I was quite amazed by how widely shared it was in Arabic and in English across the region, so much so that I think everyone was talking about the speech, in part because it appears to validate everyone's perception of what was happening. Now, Mark Carney, just in the interest of our discussion, was not just talking about the international economic system. He was speaking about the international rules-based order and its security, political, diplomatic, and economic and financial sense, which is a much bigger set of issues that go beyond perhaps what we're discussing today. And in many ways, I think most people agreed with him that we are in a kind of a rupture. But what that precisely means is something that I think most of us have tried to struggle with a bit and try to understand. And I think our previous speaker today, Kathy, may have captured it correctly, in my view, in suggesting that we are in transition away from a world we knew, felt comfortable with, and understood, towards a new world order. A new world order where it's about economic nationalism, power relations, lack of predictability, blocks that trade and maybe compete with one another, and more importantly, where the country at the center of the old order, the US, has become less committed to that order, more unilateralist, more unpredictable, and more volatile. Where we go from here, I think, becomes the interesting question. We are in a transition. Kathy suggested that, in fact, it's not deglobalization, it's reglobalization. And in many ways, I would say that is correct. Surprisingly, the trading system, for example, has remained resilient, despite everything that the Trump administration has tried to do. It has remained resilient, meaning integration remains strong. Countries are seeking to deepen trade and investment relations, but they're doing it differently. They're adjusting to the fact that we are in a less rules-based order. So trade routes are becoming not just optimized for cost, but also for security. Capital doesn't just flow in search of yields. It flows in search of where the political alignment is and where its national security interests are aligned. And similarly, a host of relations are being subjected to these security considerations, risk considerations, and the realities of an unpredictable, volatile US administration that's willing to weaponize the very tools that gave it the core elements of power at the center of the system.
The dollar.
Where we go from here, and we'll come to this, Lara, how does our region adjust? Where does the world go? Is it only about gradual weakening and the end of the system? Or do we possibly imagine, and I'll stop here, what Mike Carney suggested in his speech, that other powers, middle powers, intermediate powers, including the GCC, should start thinking about coming together with others to protect the old system and to imagine ways in which the system can continue to function on the basis of rules and order.
I'll go back to some of the points that you have mentioned, but Abdulaziz, is interesting what he said about the global trade. Despite a global war, we have seen a resilient global trade. We have seen China actually recording surplus, a record surplus in its trade that stood at $1.2 trillion. We have seen the IMF, and this is something that we haven't seen lately, raising actually its economic outlook for the global economy for 2026. It's now expecting the global economy to grow by around 3.3%. Inflation is rather steady. Equities are at all-time high, despite the geopolitics, despite the global trade war. So did we miscalculate the resilience of the global economy?
Thank you very much. Lara. It's a pleasure to be here to share the panel with my brother Tarek and Anwar. Thank you very much to the organizers for inviting the IMF to this important forum, and congratulations on the outstanding organization. I would like also to congratulate Cathy for her excellent keynote remarks, and I took note of the optimism of the tone of Cathy and labeling the forces that we are seeing now as re-globalization. This is a very optimistic view. In a recent paper by IMF staff, this period where you're seeing a deceleration in trade, meaning trade is still growing but not growing at a pace equaling what we have seen during the time of liberalization from the 1980s to the great financial crisis. So we call this period slowbalization. So it's a slowing, but we don't know, as Tarek said, where we are going to land. I think the consensus is we're in a period of transition. What is important is to understand the forces that are driving this transition. The transition is coming with great uncertainty, heightened uncertainty that we have not seen for few decades. Maybe if we exclude World War II, we have not seen it since the 19th century. It is important to understand the forces that are driving this transition. It is also important to understand that you're no longer dealing just with risk, we are dealing with uncertainty. Difference is we are no longer able to assign probabilities to events, right? Cathy had also mentioned it during her keynote speech. Now to your question, Lara, have we miscalibrated the resilience of the global economy? I would say no. There was at the beginning in April 2025, when we heard the announcement of the US increase in tariff, because of the importance of the US in global economy, global trade, there was a scare. The World Economic Outlook, the IMF cut down its growth projection, but immediately after this announcement, there was some discussion again among trade partners of these tariffs, and we have seen that these tariffs have declined. In October 2025, we have issued a World Economic Outlook where we upgraded by 0.5 percentage point the global growth, and inflation also has been reduced. This means that the world has been able to absorb the shock, maintaining economic activity, at the same time keeping inflation muted. Maybe we will come to the drivers of this resilience in the next questions, but I would like just to highlight the fact that the private sector did an excellent job. They have built buffers before. They have front-loaded consumption, private sector and the household, front-loaded consumption when they heard the tariffs, and this has contributed to sustaining demand. So this has been important buffers that have been used by the private sector and some central banks and ministries of finance in terms of fiscal policies. Fiscal policy. Going forward, these buffers will erode. It is possible that we will see the resurgence of the risks that were managed by depleting these buffers. So the point is that the shock is not completely out of the system. It is still through the system, and it is to be remain what would be the full impact of the shock. But I mean, the headline response to your question is indeed the world has been resilient, and it has also been the case for the MENA region. We'll come to maybe that later.
And when it comes to the MENA region, and especially the GCC countries, the economic growth is highly dependent on oil prices. And oil has been in the center of the geopolitics. We have seen President Trump wanting to stay as the top oil and gas producer in the world, and he doesn't mind doing that by removing Maduro, or even maybe next we're going to see Iran. So how exactly are you pricing risk and allocating capital in these geopolitics?
Yeah, thank you, Lara. First of all, let me just say good morning to everybody, and it's really a pleasure, and I'm grateful for the opportunity to share some of my humble views on this topic. Indeed, I think the energy sector has always been exposed to geopolitical risks for decades. What we have seen more recently is just the speed and volatility. It's just the frequency of events that are happening nowadays they're faster than what they used to be. So the pace of change is faster, which will require us to be more agile in how we look at those types of risks. And three things really come to mind when it comes to how we measure these types of risks and what we do in terms of mitigate them. So we look at resilience. I mean, we heard resilience a few times, but for us, resilience when it comes to investment is to make sure that we have an investment case that is resilient to the geopolitical risks as well. We built optionality and flexibility in the system because now these risks are impacting shorter cycles where there used to be longer cycles in the past. So we look at flexibility in the organization, the tools that we have in our hand to adapt and change quickly to those changing environments. And third is, what is also very important is a disciplined management of risks at the country level as well. We operate in many, many countries, and it is important for us that the team is on the ground is also able to understand the country's risks and is able to factor this into the business case that we evaluate at the corporate to be able that we have a balanced view on those types of risks. But that doesn't mean also that we do not invest anymore because of geopolitical risks. In fact, it's just a different way of looking at it and how we can adapt the internal systems so that we're able to take a measured approach and mitigate the geopolitical risk. But it is part of the business for many, many decades. We work with it, and we have, I think, the expertise that is able to understand it and have the agility within the company that is able to deal with it on a quicker pace than it used to be in the past.
Let's say, God forbid that we see a new war in the region, we see a US strike on Iran. How would this translate on oil prices? Just seconds ago, before going on stage, you and me talked about a drop of 5% in oil prices on signs that we might see a deal and rather than a war.
Yeah, oil price, of course, reacts to events fairly quickly, but the market adjusts also quickly to the changes. And I think there are enough tools in the world that is able to intervene to bring it to a comfortable level from the buyers and the sellers. For example, OPEC Plus is also able to use its spare capacity when it comes to events. So when we look at regional events or escalation, we try to understand the risk of disruption. That is what it leads to. And what does that mean in terms of the physical flow of the barrels? Yeah. So does it increase? Definitely. I think it will increase the freight cost. It will increase the shipping cost of the physical energy that is flowing around the world. So we bring this into the risk assessment that we do and make sure that we also factor this in. So if it's contained, then you expect this will stop after a short period of time, and I think the world is able to adjust and work with it. Of course, when it goes to a very high, an escalation type, then it will take more time for the world to adjust.
But on a medium-term outlook, we are talking here about probably more oil will come to the market, whether it's from Venezuela, whether it's from Iran, potentially. And this means already to a market that was sort of suffering from excess supply because of the excess supply from OPEC Plus and outside OPEC Plus members. So on a medium-term outlook, do you think oil prices, regardless of the risk premium that we are seeing now in prices, do you think that oil prices will remain low, as Fatih Birol, the head of IEA, said?
I think it's a very difficult question, and to predict the oil price shorter term or mid-term. I think there is a credible case that we will see a downward pressure on price, indeed. What we will also see is that there will be, it's not a linear decline in terms of oil price. What we expect to see is a volatile price that will adjust to the world events. But when you take an average of the oil price, you will see on average it will have a downward pressure on the price, and we will see a drop to a level where I think, like you said, short term, and then expecting that you mentioned there's maybe new supplies coming on market. We'll see, because all those projects that are sanctioned, also we will have to see whether they will also come on stream or not, whether there will be other events that are going to impact also the flow of supply. But I think there is a credible case of a downward pressure on the price short term, and I think it will adjust, like I said, with there's enough tools in the world that is able to intervene to bring it back to a normal place.
Tariq, when the United States is becoming the biggest oil and gas producer, do you think this dilutes the geopolitical influence of GCC countries?
That's surely what the United States...
Or leverage, let's say.
Well, I'm sure people in Washington, especially at the White House, imagine that this is exactly what is likely to happen, that they have more of the cards now, especially with Venezuela and the
Maybe
launch,
Iran.
and others. But I think it's probably a very misleading conclusion. The US is a production powerhouse. It produces close to 14 million barrels per day. But it's the Gulf where you have the excess capacity, the production capacity, the spare capacity that allows them to regulate the market, allows them to manage the market, and where you have the reliability and the cost advantage. I'd say that those competitive features of the Gulf as producers of oil and natural gas, along with the infrastructure, the long-term contracts, give them a formidable advantage, a resilient one, even in the face of what the US might be thinking of doing or imagining that it can do. So no, the Gulf will remain a very big, important player in the market. But the market is going to be subject to the conditions that Anwar has just described.
Let's not forget also the leverage that they have with the trillions of dollars of the sovereign wealth funds. But before we dive into that, Abdelaziz, I want to ask you about your assessment of the diversification efforts that we have seen in the GCC countries when it comes to diversifying their economies away from oil, because it's not homogeneous. If you look at Saudi Arabia, 50% of their budget revenues are coming now from non-oil sector. UAE, 75%. But if you look at a country like Kuwait, still 85% of revenues are coming from oil. So what is your assessment at the IMF with these diversification plans?
Thank you very much, Lara. Our assessment, the assessment of the IMF and of IMF teams conducting the Article 4 consultation with countries in the region is that diversification effort have been underway, and significant progress have been made in the GCC region. And there is indeed quite a lot of reasons for satisfaction and also encouragement to the countries that are lagging. So we have seen that this progress on economic diversification continue, but as you said, some of the countries are lagging. But also it is important to note that while some countries in the GCC are advancing on diversification, I want to cite maybe Qatar, for example, the UAE, Bahrain on financial services, for example, or on services in general. The composition of export in the GCC is still not as diversified, and this is overall, as diversified as in other commodity exporting countries. So this is a good benchmark, and I mean, these commodity exporting countries, you can maybe name countries like Australia, even though they're significantly larger countries, but also Malaysia, Mexico, and Norway as also good benchmark to look at in terms of assessing the room, in terms of the progress that is to be made on diversification. It is, and the diversification has been promoted, or the progress were achieved thanks to reforms, good structural reforms, including on the labor market, allowing skills to come into the country, improving the business environment, but also thanks to large investment projects. You have already mentioned the role of sovereign wealth funds. Maybe we will come to that. These large sovereign wealth funds that were enabled thanks to fiscal policy, I mean buffers from past less pro-cyclical fiscal policy that were constituted, have supported the financing of this investment project in the tourism sector, for example, in Saudi Arabia, and this has contributed significantly to diversification in the region, and making it actually more resilient to shock, domestic and also external shock, particularly. Going forward, it is important to accelerate the pace of reforms. And I would like to maybe name three messages that the IMF MD has been mentioning in the region, the three Ds, like digitalization, diversification, and digitalization, diversification, and I forget the third D, which we'll come back to, and deregulation. And deregulation. So reducing the role of the state and letting the private sector do its job is important to sustain this progress on diversification.
Thank you, Abdelaziz. Tariq, oil is sold in dollars, and that's why when most of your experts are oil, it makes sense to peg your currency in dollars. However, last year was one of the worst years for the dollar since, I believe, 2017, in many years. Since President Trump took office in his second term, we have seen a 10% correction in the US dollar. And he was clear that he's not worried about the weakness in the dollar. So does it still make sense, actually, for GCC countries to peg their currencies to the dollar when the safe haven of the dollar is being questioned?
That's a great open question, Lara. I'd say the dollar has served the region well for a very long time, and it has served the world a very important function for a very long time. The dollar is not just a currency to which many countries have pegged their own currencies. It's also a reserve currency. Predominant, most of the reserves in the world, the dominant share of reserves, are held in dollars. That's partly reflected the role of the US within the international order that we talked about. The US was not just a big trading and a big financial hub. It was also the guardian of the rules-based order. It was the center core country that managed and assumed greater responsibilities. So everything we've seen in the last year, people would argue, has been really a function not just of trade and finance, but also the changing role of the US. The US increasingly does not want to assume its global responsibilities. Its commitment to the dollar as a reserve currency that countries rely on, that the international system functions on the basis of, it does not want to continue to safeguard that role. However, the alternative to the dollar, a viable alternative, has yet to emerge. And so what we're seeing right now is a gradual move away from the dollar, a dollar hedge by central banks, by institutional investors, and I would argue increasingly also by individuals. The individuals around the world, actors, customers, businesses, who are investing in gold, who are shifting towards gold gradually as a hedge against the uncertainty, the instability, will continue. The dollar will remain the predominant currency, but over time, I would say, especially with the uncertainty in the White House, with the unpredictability, we will see a shift away from the dollar, diversification of reserves, and more importantly, to hedge against the increased weaponization of the dollar by the US, we will see alternative payment and settlement systems. These systems have been put in place, they've been developed, they're not just in Asia. Many of the countries in the GCC are part of these systems, but also in Latin America. More and more countries will be looking to de-risk their dependence on the dollar and to de-risk their vulnerability to a dollar being weaponized. So think of the next 10, 15 years as a process of transition away from the reliance of the dollar. I think that also opens the question for countries in the GCC. For how long does the peg serve these countries? I think Kuwait emerges as an interesting model. It is pegged to a basket. The basket has a dollar, but it also has other currencies. That makes it more expensive to manage, but it surely provides Kuwait with greater insurance as opposed to what is happening to other countries that are solely pegged to the dollar. So an important question that we have to stay focused on, but think about it not only through the prism of management of currencies and management of returns, but the larger questions about the international system and what the US is doing in it.
But in 10 to 15 years, do you see other currencies, not the gold, replacing the dollar? President Xi Jinping is trying to push the renminbi as a reserve currency. Would you see that happening in the coming few years?
I do. I think the Europeans, for example, for the first time maybe in a generation, are very seriously rethinking their dependence on the US and wanting to be more sovereign. That requires the euro to be not just the currency that it is today. We need to have more liquid euro markets. We need to have a common asset in Europe that can be traded and fulfills a lot of treasury needs. We need to have the euro become a truly global currency. I would say the same would have to happen with China, and there will be demand for this. So if the euro and the renminbi emerge as alternative currencies, reserve currencies, and they will, as a matter of time, along with the reforms that are needed, the shift towards the dollar will probably begin, away from the dollar will begin to accelerate, especially with the continued policies in the US. So yes, the answer.
Tarek, briefly, and the purchases that we have seen from central banks, that was mainly from China and from India. Now Europe, and given the issue of Greenland, do you think that we will see a shift also in their holdings of US Treasury, because they are the biggest holders currently of US Treasury? Do you think they will shift to gold?
Yeah. On the margin, they are shifting to gold. On the margin, everyone is hedging against the dollar. And it's not just Greenland. It's the outlook for the next year or two. It's the position of the dollar. You've talked about the correction. Imagine a following scenario where the US or the White House starts pushing for a lower interest rate from the new chairman of the Federal Reserve. That's a weakening of the dollar in the coming period. Will countries continue to be invested and committed to the dollar as they were? That policy alone will further drive countries away from the dollar. Gold emerges as clearly an attractive alternative, at least for a portion of time. But the euro and other currencies will gain gradual importance.
So briefly, because I know the audience would like to hear that question. So do you think that gold will keep on going up because of that factor, regardless of the volatility and the deep correction that we have seen in the past 2 days?
I think gold could continue to go up, but you could see also corrections in the market. This is not a market that is necessarily totally transparent. One element that is driving what is happening in gold markets, and that's a new element, I would argue, not just for common investors, but also institutional investors and countries, the element of fear about what is happening in the international system. How bad can things get worse? How much more unpredictable can US policies become? The relationship we've witnessed in the last year or so, just between the Fed and the White House, is unprecedented. The rivalrous nature of it, the very ugly tones that underpinned it, and the political pressure that was brought on the most independent monetary institution in the world. This is new. This is not going to go away. We will see what happens next.
And hopefully now things are looking better with Kevin Warsh.
We will see.
Anwar, when, of course, oil is sold in dollars, how are you looking at that? Do you see that as a source of risk for your operations?
Well, I think for a global commodity like oil and gas trading into a global market, the dollar has been a stable, dominant currency that we work well with because we build the understanding. There is transparency around it. We're able to measure it and have the systems and ecosystem around it that is able to work with the dollars for many decades. Of course, it has its own risks as well, right? There are also the sanctions, the tariffs that come along as well with the dollars that add a bit of risk. But I think when you look at alternatives, it is still a safer choice from an investment, from an energy company investing globally. It is still a currency that we will continue to work with until there is a viable, as Mr. Talib mentioned, a viable alternative that we can understand and learn from and that we're able to adapt into our systems. We can still see, at least for years to come, that we will continue to trade into the US currency.
And the oil will continue to be sold in dollars.
Indeed.
Abdulaziz, let's move to something else and discuss the sovereign wealth funds, because when we are talking about the resilience of GCC economies, we should look at the sovereign wealth funds. Together, they manage around $6 trillion in assets under management, and that translates to 40% of the total sovereign wealth funds in the world. So they have significant dominance in that area. And their strategy was rather passive strategy. They would invest in treasury bills, seeking the steady income of the fixed income market. They would rather invest in real estate. But we have now seen a shift in the policies that the sovereign wealth funds are seeking. And one of them, we are seeing them investing in or securing the advanced chips from the United States. At the same time, they are heavily investing in China and in Chinese shares. So my question to you, with the current US administration, can actually sovereign wealth funds in the region can have equal investments and strong investments both in the East and the West, or they would have to choose sides eventually?
Thank you. Thank you very much, Lara. If you allow me, I just want to say one word on the question on exchange rate and the exchange regime of the GCC economy. It's going to be very, very brief. And to reiterate what Tarek had said, from our view also, that the PEG has served the GCC countries very well. And we think it will continue to serve the diversification effort. It is important to have a stable nominal anchor to anchor the strategies going forward. But this increases basically the onus on fiscal policy and structural policies. It is important that this PEC is sustained by robust fiscal policy and structural reforms. Coming to your question on the GCC sovereign wealth fund. As we were discussing earlier, these sovereign wealth funds have been playing a greater role in the visions of the countries in the GCC, and taking a significant share of the public investment that is happening in these countries and supporting the diversification efforts. At the same time, the sovereign wealth fund are also investing abroad in terms of diversifying the assets that they're holding, and investing heavily also into the new economy, including investment in AI, in data centers, but also investing in the tourism sector in the case of Saudi Arabia, I had mentioned before. The trend that I think it is important to keep in mind for the sovereign wealth fund of the region is the large investment that we are seeing domestically. Based on the data that we see, I mean, the data is relatively scarce on the sovereign wealth fund, but based on our assessment, about 40% of the assets of this sovereign wealth fund is invested domestically, and this compared to about 16%, less than half, for other sovereign wealth funds globally that are investing more in a different horizon. We think this can pose a problem in terms of the competition it is creating with the domestic banking sector, and it can actually pose also risk, financial stability risk, and the sovereign bank nexus in that regard can be a problem can represent a problem given the heavy reliance of the domestic economy on the sovereign wealth fund. Whether they should be picking sides, I think they should be driven by efficiency, where the efficiency and return, since we are here with investors, I think I will not surprise anyone by saying that the strategy of the sovereign wealth fund should be anchored onto efficiency, long-term stability, long-term profitability. We should not also forget that the sovereign wealth fund, their prime role is to ensure intergenerational equity, meaning to invest in assets that future generation will find when they come, since they will find less of the natural resources that have been exploited.
But realistically, can they do that with the current US administration? I mean, you've seen President Trump, he was not happy at all when the Europeans went to China. So can they actually do that?
If they can actually, whether they're sovereign enough. I believe you said that these are sovereign wealth funds, right? Decision would be made sovereignly. There are indeed a possibility of maybe negotiating. U.S. administration can offer good deals, as President Trump would most likely say. But on whether they have the ability, interest, and capability to do that, maybe my colleagues can have a better response than me on that. It's a political question.
Tareq, would you like to mention something? And mind you, our time is up, so very briefly, please. About should GCC countries pick sides?
Yeah, maybe let me invoke Mark Carney again. Mark Carney suggested that if countries act alone, essentially, middle and intermediate powers, they will not succeed. They will not be able to survive in a world where superpowers are colliding, where you have multipolarity and competition for access and control driven by size. His alternative solution is for middle powers and intermediate countries to work together. I would say there is a hint of an answer there for what the GCC countries should be doing in the larger Middle East. The GCC needs to increasingly start acting as a bloc, an economic bloc, a security bloc, and a political bloc. This requires greater cohesion, greater coordination, and to sorting out of internal tensions that are increasingly beginning visible. If they work as a bloc, they can manage the relationship between the US and China. If they don't, they'll have to eventually choose between the US and China. You don't want to have to choose between both. You want to get the best of both worlds and start acting more like the European Union. I would say it's time now for the GCC to build on the ongoing discussions to have a free trade agreement with China, do a free trade agreement with the EU, build, deepen existing trade links, fortify yourself, and help in the process to cement and protect what it remains of the international rules-based order. This is an open call in many ways for the GCCs to start acting with the weight, the economic size, and the resources it has at its disposal. One further point on this. I would say one of the lessons from last year's political instability is that the GCC is no longer an island of stability that is immune to conflict spillovers from the rest of the region. This suggests that the GCC countries, led by Saudi Arabia perhaps, have regional responsibilities at the moment. A functioning, stable regional security order is good for the GCC, it's good for the region, it's good for the economic bloc, and it's good for regional economic integration in a world that is becoming increasingly regionalized, becoming increasingly dependent on blocs, and where your survival and your strength is a function of coming together and working to hedge, manage, and achieve the most that you can for your own interests.
Thank you so much, Tariq. Anwar, your concluding remarks. What are your biggest opportunities that you're seeing in 2026, and what is, in your opinion, the biggest risk for your line of business?
For 2026, I think the biggest challenge is really, we mentioned a few times, the complexity and the uncertainties that we're dealing with at a faster pace. So that is, I think, will remain a challenge for us to ensure that we've got a better understanding and we have the agility to deal with those dynamics. But in terms of opportunities from an oil and gas company, we are sitting in one of the most abundant region in terms of resources. And I think there are great opportunities that are available also for this region because we all know that this is one of the regions that has vast resources. It's got one of the lowest cost of barrel as well, which is very attractive for investments. It also has a low carbon footprint, right? I mean, these are the ingredients for a successful and even a growing and upstream business and from an oil and gas production side. That is going to be, I think, exciting for the region. In fact, tomorrow there will be an oil and gas conference in Kuwait, and I think we'll hear more from the country also what are the new opportunities that will become available.
But which region exactly? And do you think as a non-US company, when the influence of the United States is growing in the region and in new areas like Syria, for instance, do you think you would have equal opportunities? Syria, maybe Iran next?
A very good question. And look, I think all the companies will have a limited capex that they can invest in the region or anywhere else. And I have looked at the number yesterday, which is between 2013 to 2023, the industry spent $2 trillion just to sustain production, $2 trillion. Because of course, natural decline happen in the fields and you need to keep investing just to sustain what you produce currently. So I think from a US or a non-US companies having a role in this region, I think both do have a role. I think we are also in a region where history, relationship, loyalty valued greatly in the region. And I think, for example, Shell has built a partnership in countries for many decades and will continue to be in those countries for many decades to come. I think the countries will need to decide for themselves what is best for them and what will be the best international oil company or a company that will bring most value to them. But I'm sure there will be enough for everybody to play a bigger role in the region.
Thank you, Anwar. Thank you, Tariq. Thank you, Abdulaziz. With this, we conclude, and thank you so much for your attention. Thank you.